Class 12 Accountancy presented by NCERT.com. In this video, we are going to provide accounting for partnership basic concepts, special aspects of partnership accounts. In the previous video, we discussed about the partnership deed. In this video, we are going to discuss about the special features or special aspects of partnership accounts. In the previous class, you have learned about the solo proprietorship related to accounting. The accounting for partnership firm is also almost the same as that of a solo proprietorship. However, there are very few minor differences between how the accounts related to the solo proprietorship and partnership firms are treated. The special aspects of partnership firm are as follows. 1. Maintenance of partners' capital accounts. Note that in case of partnership firms, there will not be a single capital account. As there will be multiple partners, we need to maintain multiple capital accounts, one for each of the partners. So, if there are 4 partners, there should be a capital account for this partner, there should be a capital account for this partner, there should be a capital account for this partner, and there should be a capital account for this partner. The next special aspect of partnership firm is the distribution of profit and loss among the partners. In solo proprietorship, there was only one owner, and all the profit or loss will belong to this proprietor. However, in case of a partnership firm, as there are multiple partners, we need to distribute the profits among all the existing partners as per the partnership agreement or as per the provisions in the Indian Partnership Act. This is applicable to any loss also. The next special aspect is the adjustment for wrong appropriation of profits in the past. This comes into picture if there are any errors in handling the salary, commission, interest on capital, interest on drawings, etc. in the past. If there were any errors in the past, they should be handled appropriately in the current accounting period. Suppose a partner was paid 10,000 rupees of additional salary in the past. We need to adjust this partner's account to ensure that those 10,000 rupees are recovered or adjusted. The next special aspect is the reconstitution of a partnership firm. When there is any new partner joining the firm, or an existing partner leaves the firm, or there is any death of any partner in the firm, it should be handled accordingly. We will look into this aspect in detail in the next chapter. The next special aspect is dissolution of partnership firm. Now, what is dissolution? Dissolution is formally ending. That is the literal meaning of dissolution. Here we are referring to formally ending the partnership firm. Some partnership agreements will be for fixed period of time, something like 2 months or 3 months or 4 months or 1 year, etc. or until a specific project is finished. Once that period is completed, the partnership comes to an end. In some cases, there might be winding up of the business due to losses or the partners are no more interested in continuing the partnership. This should be handled separately. This will also be discussed in one of the next chapters. That said, we'll discuss only the first 3 special aspects in this chapter one by one. Let us start with the first special aspect of partnership accounts, wherein there is a need of maintenance of separate capital accounts for each of the partners. By maintenance of the partners' capital accounts, I mean all the postings that will be done into the capital account. The main purpose is to reflect the exact position of the capital held by each partner at any given point of time. So, we post everything that will affect the capital belonging to each of the partners into this account. So, whenever there is additional capital added by any partner, that will be posted in the capital account. Whenever there is any withdrawal by any partner in the form of the drawings, that will go into the capital accounts. See, the partners want to put all their capital intact in the business. But in human life, there could be a number of personal requirements like a partner's sibling or kid wants to study abroad and they want money for that purpose. someone in the family was hospitalized on emergency. They need money for that purpose. They want to buy a new house or new vehicle and so on. Human requirements are unlimited and unpredicted. So, a partner might think that, okay, anyway, my money is available in the business. I will withdraw some amount. Getting a loan from outside is difficult and this is the easiest thing. He might think like that and withdraw the money. But to discourage the partners from withdrawing money, the partnership agreement usually contains a clause about the interest to be paid on drawings. This will prevent the partners from unnecessarily withdrawing the money from the business. But yeah, if there is really a need, they don't have any other option and proceed with withdrawing the money. The next thing that should be posted in the partners' capital accounts is the share of profits that the partners are entitled for. We add the corresponding amount to the capital account. Here, by profit, I mean either profit or loss. Any one of these. I mean not both of these, any one of these. Either profit or loss. The next thing that need to be posted in the capital accounts is any interest on the capital. We learned that we have to pay the interest on the capital if it is part of the partnership agreement. Otherwise, if the partnership agreement is silent about the interest on capital, there is no interest on capital that need to be paid as per the Indian Partnership Act. The next thing that will be posted in the capital accounts is interest on drawings. This is posted only if there is any drawing, right? Otherwise, this need not be considered for posting into the capital accounts. Also, just like the interest on capital, the interest on drawings should be considered only if it is agreed in the partnership agreement. Otherwise, if the partnership deed is silent about the interest on drawings, then as per the Indian Partnership Act, no interest need to be paid. The next thing that will be posted to the capital accounts is the partner's salary. Again, for this also, a salary should be paid to a partner only if it is agreed in the partnership agreement. Otherwise, if the partnership deed is silent about the salary to a partner, then as per the Indian Partnership Act, no salary need to be paid to a partner. The next thing that will be posted to the capital accounts is the partner's commission. Again, for this also, a commission should be paid to the partner only if it is agreed in the partnership agreement. Otherwise, if the partnership deed is silent about the commission to be paid to a partner, then as per the Indian Partnership Act, no commission should be paid to the partner. Now, when it comes to the actual preparation of the capital accounts, we have two methods. The first one is fixed capital method. The second one is fluctuating capital method. In case of fixed capital method, when the capital is added or part of the capital is withdrawn, we record it in the capital accounts of the partners. However, when it comes to the recording of the salaries, commission, profits or losses, interest on capital, drawings, interest on drawings, etc., we maintain a separate account, namely partner's current account. I repeat, we maintain another account, namely partner's current account, to post all these transactions. Whereas in case of fluctuating capital method, all these transactions will be posted to the partner's capital accounts. In other words, no separate current accounts will be maintained for the partners. Let us now discuss the fixed capital method in detail. In this method, the capital account will remain fixed. The only way the capital changes is either by adding additional capital or by withdrawing part of the capital depending on the agreement among the partners. Note here that when I say withdrawing part of the capital, it is different from drawings. In other words, here we are referring to permanent withdrawal of the capital itself. Let us understand this by taking one example. Suppose there are two partners in a firm. Partner A contributed 1 lakh rupees. Partner B contributed 2 lakh rupees. Suppose a new partner joins the firm and brings in 1 lakh rupees of capital as his share. There is no change in the business capital requirement and the business needs only 3 lakh rupees as capital. So the partner B might withdraw 1 lakh rupees. So when the new agreement is prepared, when the new partner joins in, the capital of the partner B will be drafted as only 1 lakh rupees. This is what I mean by withdrawing of the capital permanently. Just remember that the withdrawing of capital and drawings are two different things. It is important that you understand the difference between the two. As we have already discussed, the share of profit or loss, interest on capital, drawings, interest on drawings, etc. are recorded in a separate account, namely partner's current account. Also remember that when there is capital brought in by the partners, it will be credited to the capital accounts, right? So the capital accounts always show a credit balance. This credit balance remains the same or fixed from year to year. The only way it changes is when there is an additional capital brought in by the partner or there is any withdrawal of the capital by any of the partners. Also note that it changes only for the partner who has brought in the new capital or has withdrawn the capital from the firm. It remains fixed for the other partners who have not added or withdrawn the capital. So, the capital accounts of the partners always show a credit balance. Now, if you consider the partner's current accounts, it might contain either debit or credit balance. To summarize, in the fixed capital method, there will be two accounts, namely capital and current accounts for each partner. I repeat, these two accounts are maintained for each partner. As you know, at the end of the accounting period, the capital account appears on the liabilities side of the balance sheet in the sole proprietorship, right? Similarly, each of the partners' capital accounts in the partnership firm also appear on the liabilities side of the balance sheet. I repeat, the balance sheet contains an entry for each of the partners' capitals. If there are two partners A and B in the firm, this is partner A's capital account and this is partner B's capital account. Now, when it comes to the partner's current accounts, if there is a credit balance, we should show it on the liabilities side. So, we enter A's current account and B's current account on the liabilities side. If there is any debit balance, we should show it on the assets side. So, we enter A's current account and B's current account on the assets side. The format of the partner's capital accounts will be as follows. The first thing in the capital account is any balance brought down from the previous accounting period, which will be opening balance of the specific partner's capital account. As we have already discussed, there will always be a credit balance in the partner's capital account. Then we should enter the fresh capital introduced. This is usually deposited in the bank, right? So we write bank account in the particulars column. Note that this entry appears only if there is any new capital introduced into the business, and it appears only for the partner who has introduced additional capital into the business. Then we should enter any capital permanently withdrawn. This is also usually withdrawn through the bank, right? So we write bank account in the particulars column. Note that this entry also appears only if there is any permanent withdrawal of the capital. And then the final entry would be any balance carried down to the next accounting period. This is always a credit balance and we should write it on the debit side. And then finally, the partner's capital account is totaled and balanced. Now let us discuss the postings that will be done to the partner's current accounts. Here, the first entry would be any balance brought down from the previous accounting period. If there is any debit balance, it will be brought down on the debit side. Similarly, if there is any credit balance, it will be brought down on the credit side. See, just for the sake of your information, we are writing the balance brought down on both sides. But in real practice, the partner's current account and for that matter any ledger account can have either debit balance or credit balance, right? Also note that if there are multiple partners, it could be a debit balance for few partners and it could be credit balance for the others. It's not necessary that all the partners should have a debit balance or all the partners should have credit balance. It depends on the transactions that go into the individual partner's current account. The next thing is the salary that should be paid to any partner as per the terms of agreement. Again, remember that the salary is paid only if it is agreed in the partnership deed. Otherwise, if the partnership deed is silent about the salary of the partner, as per the Indian Partnership Act, the salary need not be paid to any partner. The next thing is the commission that should be paid to any partners as per the terms of agreement. Once again, the commission is paid only if it is agreed so in the partnership deed. If the partnership deed is silent about the commission to be paid to any partner, then no commission is required to be paid to the partner as per the provisions in the Indian Partnership Act. The next thing is the interest on capital that should be paid to the partner as per the terms of agreement. Once again, the interest on the capital is paid only if it is explicitly agreed in the partnership deed. If the partnership deed is silent about the interest to be paid on the capital, then the interest need not be paid on the capital as per the provisions of the Indian Partnership Act. Now let us discuss the postings to be made on the debit side of the partner's current accounts. If there are any drawings by any of the partners, then the corresponding partner's current account should be debited with the drawings amount. Note that this entry should be debited into the partner's current account only if there is any drawing made by the partner. If there are any drawings by any of the partners, then the corresponding partner's current account should be debited with the interest on the drawings to be collected from that partner. Note that this entry exists only for those partners who has taken some amount from the firm as drawings. Now, the interest on the drawings should be debited to the partner's current account only if it is explicitly specified in the partnership deed that the interest should be collected on the drawings. However, if the partnership deed is silent about this aspect, then no interest should be collected on the drawings as per the provisions of the Indian Partnership Act. The next thing that should be credited to the partner's current accounts is the share of profit. Note that the profit should be credited to the partner's current accounts only if there is a profit. If there is a loss, it should be debited. Now, the profit and loss comes from the profit and loss appropriation account. It's not directly from the profit and loss account. We'll discuss about the profit and loss appropriation account in the upcoming videos. But for now, just understand that the profit or loss comes from the profit and loss appropriation account, and this profit and loss appropriation account is an extension of the profit and loss account and is applicable for partnership firms. The literal meaning of the word appropriation is equivalent to distribution. Anyway, this is just for your information. Now, coming back to our discussion, if there is any profit, we should create the partner's current accounts. Note that we need to write the profit and loss appropriation account in the particulars column. Similarly, if there is any loss, we should debit the partner's current account and we should write the profit and loss appropriation account in the particulars column. Also note that the profit or loss is shared among the partners in their profit and loss sharing ratio, simply called as profit sharing ratio or PSR, if it is explicitly specified in the partnership deed. However, if the partnership deed is silent about this aspect, the profit or loss should be shared equally by all the partners, irrespective of their capital, as per the Indian Partnership Act. Once all these entries are made, they are closed by posting the balances, which could be either credit balance, which is written on the debit side, or it could be a debit balance, which is written on the credit side. And finally, the partner's current accounts are totaled and balanced. With that, we have come to the end of our discussion about the fixed capital method of maintenance of the capital accounts of the partners. The next method of maintenance of the capital accounts of the partners is fluctuating capital method. In this method, only one account is maintained for each of the partners in the firm. All the adjustments for salary, commission, interest on capital, interest on drawings, sharing of profit or loss are posted directly in the capital accounts of the partners. Because of these adjustments, there will be adjustments or changes in the partners' capital accounts from time to time. As the partner's capital changes or fluctuates from time to time, we call this account as fluctuating capital method. When you are actually solving the problems, if there are no instructions given, then we should prepare the capital accounts using this method. For your understanding, just assume that whatever entries we made in the partner's current account in the previous method, all those entries will be made into the partner's capital accounts in this method. That's it. Considering this, the pro forma of capital accounts prepared in this method will be as follows. It starts with any debit or credit balance from the previous accounting period. The next entry would be any capital introduced in the business through bank. Also, if there is any permanent withdrawal of the capital, it should be posted. any drawings by any of the partners through bank. Note that, as we have discussed earlier, the drawings are different from the permanent withdrawal of the capital. Any salary to be paid to the partner, any commission to be paid to the partner, interest on capital if there is any, interest on the drawings if there is any. If there is any profit, the corresponding profit share of the partner goes on the credit side. If there is any loss, the corresponding loss share of the partner goes on the debit side. And then any balance to be carried down. Any debit balance is written on the credit side. And if there is any credit balance, it is written on the debit side. Finally, the totals to ensure that the capital account is balanced. Now, after discussing the fixed and fluctuating capital accounts, let us now understand the differences between the fixed and fluctuating capital methods. Let us have the headers for the basis of distinction: fixed capital heading and fluctuating capital heading. Now, when it comes to the number of accounts, it is straightforward, right? In the fixed capital method, two separate accounts, namely capital account and current account, are maintained for each of the partners. So, if there are 4 partners in a firm, we need to maintain 4 capital accounts and 4 current accounts. Whereas in case of fluctuating capital method, only one account, namely capital account, is maintained for each of the partners. So, if there are 11 partners in a firm, we need to maintain 11 capital accounts. When it comes to the items related to the deed, in the fixed capital method, we post the items related to the deed like salary, commission, drawings, interest on capital, interest on drawings, profit or loss share of each partner to the current account. Only fresh capital introduced or any permanent withdrawal of the capital are posted in the capital accounts. In the fluctuating capital method, all these items are posted in the capital accounts. Now let's discuss the differences from the perspective of fixed balance. In case of fixed capital method, capital account balance usually does not change. Only when a fresh capital is introduced by a partner or any permanent withdrawal of the capital by a partner, there will be change in the balance. Whereas in case of fluctuating capital method, the capital account balance fluctuates from one accounting period to the other. Now let us consider the credit balance of the capital accounts. In case of fixed capital method, the capital accounts always show a credit balance. Whereas in case of fluctuating capital method, the capital accounts show either credit or debit balances depending on the postings made to the capital accounts. That's all about the maintenance of capital accounts of the partners. In the next video, we will discuss the topics related to the distribution of profit among the partners, starting with profit and loss appropriation account. Thanks for watching. Edixit.com is started to promote effective and efficient learning process to help the students with their learning requirements. To watch all our videos, please subscribe to our channel. Also, please click on the bell icon to receive a notification as soon as a new video is published. Please click on the like button if you like this video. Thanks for watching.